Hello investors and traders. This video will explain the basics of the CCI indicator and how you use this technical indicator in your investing or trading strategy. As usual, one indicator does not make a strategy and should be coupled with other indicators and philosophies. Study it, analyze it, adapt it. The CCI or Commodity Channel Index was developed by Donald Lambert, a technical analyst who originally published the indicator in Commodities magazine, now Futures, in 1980. Despite its name, the CCI can be used in any market and is not just for commodities. Key takeaways. The CCI is a market indicator used to track market movements that may indicate buying or selling. The CCI compares current price to average price over a specific time period. Different strategies can be used the CCI in different ways, including using it across multiple time frames to establish dominant trends, pullbacks, or entry points into that trend. Some trading strategies based on CCI can produce multiple false signals or losing trades when conditions turn choppy. The CCI compares the current price to an average price over a period of time. The indicator fluctuates above or below zero, moving into positive or negative territory. While most values, approximately 75%, fall between minus 100 and plus 100, about 25% of the values fall outside this range, indicating a lot of weaknesses or strength in the price movement. A period refers to the number of price bars the indicator will include in its calculation. The price bars can be 1 minute, 5 minute, daily, weekly, monthly, or any time frame you have accessibility on your charts. The longer the period chosen, the more bars in the calculation, the less often the indicator will move outside minus 100 or plus 100. Short-term traders prefer a shorter period, fewer price bars in the calculation, since it provides more signals, while longer-term traders and investors prefer a longer period, such as 30 or 40. Using a daily or weekly chart is recommended for long-term traders, while short-term traders can apply the indicator to an hourly chart or even a 1-minute chart. Overbought and oversold basics for the CCI. Generally, the value of the CCI being above the plus 100 level to the upside is termed overbought. Conversely, a CCI value below negative 100 level is said to be oversold. Overbought and oversold thresholds can vary greatly for individual stocks. More volatile markets will have a greater thresholds. It is not uncommon for stocks to have thresholds at plus or negative 200. CCI is an unbound indicator, meaning it can go higher or lower indefinitely. For this reason, overbought and oversold levels are typically determined for each individual asset by looking at historical extreme CCI levels where the price reversed from. Throughout my trading career, looking at extremes has helped me a lot. For example, with the VIX and the VXN. Let's take a look at CCI at extremes. If we put a level of 200 plus minus 200, which is an overbought, oversold level, we can look at parts where it has become extremely extreme levels throughout the years. The more years that is at extreme, the more possibility of a reversal. We're going to wait for the CCI to hit an extreme level, and then we're going to look to take a reversal trade in the opposite direction. A key point is, don't fight the overall trend of the market. For the last 10 years, the overbought levels on the CCI has not worked as well as the oversold levels. So do not fight the overall trend of the market. If we are in a bull market, be cautious on the shorts, but extreme levels on oversold assets on the CCC are a buy. So look at the macro picture. It becomes very important. We have videos about an approach called forest to trees strategy. Again, the CCI is very effective at extreme levels while following what has been a positive trend. Line crossovers on the CCI high to low with a zero being the middle ground. Once the CCI crosses above the zero line, it is an entry signal buy. When it crosses below the zero line, it is a sell. The reason the zero line is a powerful entry is if you look at the CCI as a moving average crossover, we will see the zero line is where the moving averages crosses over the crossovers. That is if you look at the CCI as a 1 period moving average and a 10 period CCI period. This period is a moving average. Once your typical price or your asset crosses over the longer term moving average of the typical price, these are the areas you will see hitting the zero line on the CCI indicator. So as we cross below the zero line, the typical price is crossing below the longer term moving average of the typical price, giving us a bearish entry as the CCI crosses above, that is our typical price of the asset, exceeding the moving average, giving us our bullish buy entry for the CCI. Couple overbought and oversold signals using the levels that the CCI has defaulted, which is 100 and negative 100, and those levels are picked by the creator of the CCI to account 75% of your price action is going to happen between those lines. And that is the denominator of the calculation 0.015 to ensure that approximately 75% of price action occurs between those levels. Once we exceed one of those levels, we are entering maybe an overbought or oversold signal and looking for a momentum burst. CI above zero indicates price is above the historic average. When trading above zero, the current price is above its historical average. CCI is below zero, the current price is below its historical average. Low readings below negative 100 indicate the trend has been to the downside. Readings above 100 indicate there has been a trend to the upside. As you see by the graph, when the CCI trades above zero, it set off a long-term bullish trend on this security. It is very helpful when the CCI crosses above zero for the long side and when the CCI crosses below zero for the short side. Remember to pay attention to the overall macro view. Based on this information, an emerging bullish trend would be going from negative or near zero readings to 100 can be used as a signal to watch for an uptrend. Move from below zero to plus 100 is getting ready to move higher. A pullback to the zero level can be a buying opportunity. When the stock is moving to the upside is when to get in. CCI is very helpful. Let's look at this chart. When the CCI readings fell under minus 100 at somewhat extreme lows, it shot off below zero, and when it crossed below zero, it had a great run. So many traders use where it falls below minus 100 and then recrosses above the zero line and stays above the zero line for a bullish movement. Confirming a bullish trend during a strong uptrend, the CCI will typically remain above the plus 100 level. Staying at higher levels may confirm the strong trend as long as the CCI remains above 100. Just a key point, remember extreme peaks we talked about in the beginning of the video. As you see from this chart, when the CCI stays above zero or even moves above 100 and stays there for a long period of time and trends in that direction, this also is a signal of a long-term bull move. Let's look at this chart a little bit. At the beginning of the video, we told you that on this security, a negative 200 is an oversold level. We went back many years to see that these levels have not been broken, which means an oversold level. And on the opposite side, the above 200, where the security kept going up and up and up and would not go down, and we went back 3 or 4 years, the CCI works very well to show you an overbought level. Remember, do not go against the macro, the overall market. So if the overall market is positive, which it has been for the last 10 years, and the CCI goes to an extreme level, it's a great opportunity to buy. If the market is negative or a security is negative and it reaches extreme levels of buying, it is overbought. Those are at extreme levels. But let's take it at below average levels and downtrending levels at the beginning, minus 100 and minus 200. If the majority of time the security is in the below average area, and especially hitting the downtrending area, this is a poor stock. This is a stock to short. You can see the historical weakness of this stock. Next, let's talk about the above average and uptrending. If the security is trading from 0 to 200 or in that range, it is a time and showing great strength in this security. Sometimes this security might go low to the downtrending, but it quickly goes up to the above average and hitting the uptrending cycle. This is a very powerful stock. Let's hit a scenario. The overall market is positive. The macro is positive. Bad news comes out over the market and sends the market down for 3, 4, 5 days, 7 days, which sends the CCI down to a very low oversold level, extreme level. It stays at this extreme level and bounces for 3 or 4 days. Then suddenly it crosses the zero level, which sets off a buy signal, and it continues for the next 3-4 months in the above average uptrending cycle that it is in. The CCI is a powerful tool. And if you come up with your own set of rules, or even follow this video set of rules, it will help you in your financial and trading success. Remember, come up with your rules. CCI divergences. Divergences is when peaks in price action are not confirmed by the CCI. Bullish divergence is when the stock is making new lows, but CCI does not. Bearish divergence occurs if the stock is making new highs while the CCI is not. Price is going one way, but the CCI is going another way. The theory in this case is that price ultimately resumes in the direction of the CCI. In this chart, the divergence that we have here is the price was falling lower, but the CCI was not. Again, if you look at this chart, the CCI was not confirming a lower price, thus making a divergence, thus setting off a major uptrend. Key takeaways of the CCI. The CCI works in a variety of markets. The CCI is a powerful indicator. The CCI should not be used as a standalone indicator, but coupled with other indicators to use a weight of evidence. One indicator does not make a successful system. Please watch the other videos, MACD, RSI, etc., to combine these indicators to make a rule-based strategy. There are many interpretations of how to use the CCI. Many trading systems and software programs are based on the CCI. Study it, analyze it, adapt it. Peace.